Hello and welcome. Moss Adams is pleased that you joined us for today's session, Financial Institutions Navigate Digital Asset Regulations. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now that we have our housekeeping items out of the way, I'm going to pass it over to Gabe Nachand, partner and national practice leader here at Moss Adams. Gabe?
This is Gabe. As mentioned, Financial Institutions National Practice Leader for the firm, and I'm also with my fellow partner, Aran Loftus. We've got a lot to cover today. I'd like to briefly introduce our keynote speaker, Ken Goodwin Jr., Managing Partner and Founder of Jeanensis Ventures. He's got an impressive resume, international banking, fellow at Federal Reserve, prominent speaker on blockchain and all things digital transformation. And got a few more comments there, but let's get to our first polling question, and then I'll make a few more comments before we hand it over to Ken.
Great. So here's our first poll question. Who's joining us today? I am, or I'm with, a depository financial institution. B, fintech. C, other company interested in regulation around digital assets. D, just curious to learn more.
And while you
I'll give you a few moments to
while you're answering that question, I wanted to add a few more things. Ken is prominent speaker on FinTech TV. He has been part of commenting on the congressional hearings that took place this morning, as well as the Dealbook FTX interview that took place yesterday with SBF. I can tell you what we planned to present months ago has changed pretty much every day since then, and so it's going to be quite the interesting conversation. But what I've really been impressed with Ken about is you can find a lot of expertise on digital assets, and then you can talk the regulation side, but I don't think I've met anybody that's is knowledgeable in terms of the intersection of regulation and where it potentially could go in digital assets. So that's very excited about today, and I'll go into the background and monitor the chat or monitor the questions. But first, the results.
Great. And just a reminder to click that radio button next to your answer on your screen and hit submit to submit your answers. And I'm going to go ahead and forward us on to the results.
All right. Well, we do have quite a few folks here looking to just learn more, which is always great. And then we directly market it to the financial institutions. So glad to see it spread out from there. But I think we kind of knew the audience coming in. And Ken, I'm officially going to hand the reins over to you. And I think you might be on mute. Ken, I think you're on mute. Danielle, are you? I think. Apologies. I think Ken is frozen for the moment. He'll need to push S5, and so he will be back here shortly as the screen refreshes.
And just a reminder, we do have a few questions coming in regarding polling questions. When they do pop up, you'll notice them in the slide view. So if you have your slides minimized, you can go ahead and choose those from the icons below. And then you'll just select the radio button next to your response and hit submit. And it looks like we've got Ken back, so I'll pass it over to Ken.
Yes, I just want to make sure we can hear each other. Is that fine?
Everything's great.
Yes.
Okay. Your WebCast's worst nightmare is over.
Yes. Thank you very much, Moss Adams, for the opportunity to present today on financial institutions and navigate digital assets regulations. When we started to do this presentation, it was basically a fundamental presentation on blockchain, cryptocurrency, and digital assets. As you probably already know, the industry has gone through a significant change within the past month. And some people like to say that we're going through a crypto winter. But I think that we're going through a similar period of time to my experiences when I was at the Federal Reserve Bank of New York during that time through Dodd-Frank. Very much similar to a Lehman Brothers experience. So there's a lot of changes that's happening. As is well aware of what's happening, what's going on with Sam Bankman-Fried, with FTX, and also the other institutions that are involved. We'll navigate that somewhat today because this is an ongoing conversation, especially today. There was the U.S. Congressional Committee, the Agricultural Nutrition Committee that happened today with the chairman of the CFTC, the Commodity Future Trading Commission, and pretty much trying to get a handle as to what was going on in this space. So here's some key topics we're going to discuss today: the fundamentals of blockchain technology and cryptocurrencies. Again, that's going to be done with a little bit of asterisks because we'll make some real cases out of this. Efforts by prudential regulators such as the SEC, the CFTC, the actual Treasury, the Fed, the OCC, the FDIC, in overseeing these digital assets. Methods to identify, measure, monitor, and report fraud and illicit activities common within the decentralized platform. The reason why we use identify, measure, monitor, and report, typically most regulators use this as a way to mitigate risk. So whenever you mitigate any kind of risk, you have to identify, measure, monitor, and report. So let's start with the beginning. I love to start off with Mark Andreessen. And not because of the large investments that the firm actually had in FTX, but most importantly, the foresight that he actually had in discovering or talking about Bitcoin or cryptocurrencies. And if you go back, this is a gentleman who is well known in this space for the web, for the internet. But he makes the comment, personal computers in 1970, the internet in 1993, and I believe Bitcoin in 2014. So here you can see the foresight of one of the leaders in the industry in terms of trying to figure out what has actually happened to Bitcoin. And if you go back in those days, a lot of people like to discuss what's the origin of Bitcoin and cryptocurrencies. I always like to go back to the white paper that was established by Satoshi Nakamoto. Now, we don't know if this person is a person or an individual or an entity or a corporation or a person. You can kind of figure out who this person is, a he or she or it. But the white paper was really, really critical because it established and it brought to an idea about how do you take digitization and apply that to payments and settlement. So how do you digitize the payment and settlement structure? And as you know already, the payment and settlement structure is a huge structure here around the world that, of course, coming from the Fed, you had Fed-wide. So you got trillions of dollars going to the payment and settlement structure on a day-to-day basis. But the idea here was how do you digitize that? And how do you make it a lot more easy to operate without the advent of actually having a centralized function? So how do you decentralize that and make it as if you and I was to trade or change or exchange money very fast? Immutability, operability, transparency, those are the key terms that you're going to constantly hear that's being described. So we really describe the infrastructure. Bitcoin, the actual token itself, is the after effect of that. And I like to say this, and I say this openly, that Bitcoin is the subset of the actual technology. So you have the Bitcoin protocol, but you also have the Bitcoin in itself, the cryptocurrency. Let's move a little bit more into the industrial side. And this is someone we're very familiar with, Mr. Jamie Dimon. And I'm sharing this side because one side is very much industry perspective in terms of blockchain and cryptocurrency industry perspective. And the other side is what you get in the institutional side today, one of the leading banking firms around the world, the CEO. And his comment was, there will be no real non-controlled currency in the world. There's no government that's going to put up with it for long. Now, the irony behind that, with all the things that happened to FTX, you're starting to see more governments more involved. You're going to see later on in this presentation, we'll discuss a little bit about what is a central bank digital currency. You're seeing more of regulations that are being discussed. We'll discuss that a little bit more. But you're also seeing financial institutions getting more involved in this space, mainly on the blockchain application side. So the reason why I like to bring these two together is because you're going to start to see that one area is really centralized and the other one is decentralized. And what we'll see is that centralization plus decentralization will equal a distributed network. So let's start with the first black eye in the industry. We had multiple experiences within the cryptocurrency space, but the very first one started off with the Silk Road. Use of Bitcoin gained traction on the online black market, known as Silk Road, and this culminated with a famous capture of Ross Ulbricht, aka Dread Pirate Roberts. And that was significant because as the cryptocurrency, as Bitcoin was picking up, you had this experience with the Silk Road. And eventually that led into what's going to happen next, Mount Goy, right? Which was at that time one of the largest exchanges in the world. And unfortunately, there was a huge hack that occurred, very death and fraud. And the question behind that is, where did our money go, right? So where did your money go when you start to put your money and you have a wallet and you use it on an exchange, and all of a sudden that's gone? So that led into an actual bidding that occurred. The IRS was able to go in and confiscate some of those cryptocurrencies, and they actually had an auction. And that auction led into certain individuals using that to use that as capital to create their firms and so forth. But the key here is that this was undergoing an extreme change at a very early stage. So we knew fraud and theft was occurring in this space for quite some time. So we talk about trust, right? So the blockchain, the way I describe the blockchain, I look at this in the way of it's a distributed ledger technology network. The best way to kind of look at this is a public ledger. And the idea is that how you're able to gain trust as you use this technology. Of course, what's going to lead to that is you're going to have sensitive data. And that's the most important thing to think about. But we'll talk about the components of what that looks like. But we know that in this space, that everything's constantly changing. So data is very important. It's the leading underlying fundamental in establishing a cryptocurrency or blockchain technology. That leads into what may happen later on with APIs and cloud, but there's multiple different technologies that's occurring in this space at the same time. But let's break down cryptocurrency or blockchain technology. I like to start off with this first. Data proliferation is the key here. The argument back in this space for quite some time, at least within the crypto and blockchain pundits, is that they want to bank the unbanked. And those who are banking, I come from a banking background, come from the Fed for about 10 plus years at the Fed, but 20 plus years within the financial industry. And you understand that banking requires a level of documentation. So you just can't go into a branch and open up a bank account. What you actually need is documentation that's verified, that verifies your ID. And data proliferation is the key. So the ability to have sound data that extracts your identification is the most important thing. So it was never about bank the unbanked. It was always about having the proper documentation to verify your ID. So keep this in mind. It's very, very critical in understanding what is a distributed ledger technology. The next step in that is the platformization of that. And the platformization of that includes the process of taking that data and making it and executing it. And the execution component of that is the centralization or decentralization. In the traditional banking system or in traditional financial system, decentralization requires for some kind of middle person or middle market or some kind of middle function to use for internal controls. So you're going to use an internal function as a way to conduct audit for the data that you provide that helps you to finalize your execution. Decentralization, what it does, it removes that. It removes that feature. Now, there's some pluses and cons to that. The plus is that, A, it's immutability. You can't change it as much. You can't go backwards. B, there is a level of transparency. And C, it is fast. However, in terms of the internal controls, you technically don't have the internal controls there. The final portion of that is products. From all of this, the technology, there are products that are being produced. And today, some of these products we hear central bank digital currencies, non-fungible tokens, stable coins. These are products that are established from this technology, this blockchain technology. So if you apply this to any technology, you can understand it a lot better. That is first, which leads into the process and procedures, and in the case of blockchain, protocols, which leads into the products itself. And that is how regulations are going to be established. The reason why I brought this up is that a regulator mindset is to think in this manner, right? They're going to think in this manner, where did the original information come from? How does it affect operations, right? How does it affect products in terms of product suitability? And looking at product suitability, you're looking in terms of consumer compliance and investor compliance. So this is a very important slide to take a look at. So blockchain application, as mentioned before, centralization, decentralization, distributed network. Now, here's what's very important about this particular notion here. The idea of centralization, that's been around forever. We're familiar with centralization. Now, when you look at Web 1.0, Web 1.0 was actually a really good decentralization platform because it was computers talking to computers. So one machine would talk to another machine, and technically you didn't have that middle person. As it gotten bigger, Web 2.0 became more centralized. So when you look at Web 2.0, that's the ability to go out and get the .com and get your .com addresses. So in order for you to get those addresses, you had to go to an entity or a function to get it. And that was a central function. Now we're at a point of Web 3.0, which is a distributed network. So you have multiple nodes, multiple information connected towards each other. And that interconnection is what caused an information or caused a transaction to occur. So the blockchain is more a distributed network in a sense, a combination of centralization and decentralization. The blockchain application, crypto digital asset space is changing. So the crypto market is still at least above $1 trillion. It's changing significantly since the time that this came out. The question is whether or not it's going to go a lot lower than that trillion. I can't really predict or say. Today, people are looking at Bitcoin prices around 16K. Some people may predict Bitcoin prices may go below that to about 10K. If it goes below 10K, I'm hearing on the street, if it hits 8K, it's a problem. But if you look at the projection, 2 years ago, market cap was around 250 billion. So there's some growth here. It's hitting a point where now it's a flight to quality, flight to value. And almost 100 cryptos with a market cap above $1 billion, that's changed a lot. I would say that now that number is probably going to hit maybe between 50 to 75 because of FTX. So you can see the impact that the FTX is having on the space in general. The first Bitcoin ETF launched in October 2021. And there's some discussions now for other Bitcoin ETFs to be launched. Of course, you had BlackRock is talking about their Bitcoin ETF, I believe, as well as Fidelity. So you're starting to see more large players into this space. And the reason why that's the case, part of it is because of the fact that these companies do have an infrastructure in place. So don't rule that out. Companies such as Fidelity and BlackRock, they could invest into the crypto space and lose about 250 to 300 million and not really take a big loss. But they do have the infrastructure in place. They have the governance and the risk and controls in place, and they have the regulatory regulators looking over them and understanding what it takes to look at risk. Native crypto companies are forming banks. That is still the case. The irony behind this is that the blockchain industry at first wanted not to include banks, but now they start to realize that you do need banks, or if not banks, you do need an entity to safeguard against your digital assets. So the most important thing to recognize is that you do have an entity that is a custodian that protects and oversees your digital assets, your digital wallets. Exchanges, of course, are undergoing a lot of changes with FTX. You have unfortunately, more firms that are closing down or will be closing down their operations. Crypto custodians are still around. People are still looking at that. The custodian business is it's a big business. And it's a worthy business. With custodianship, you're allowed to build more products. You're allowed to do more transactions if you are registered or if you are regulatory compliant. Stable coins are still around despite some changes that are happening in this space. There's 4 types of stable coins. There's one that's geared towards the foreign exchange, that type which is geared towards USD. The other type of stable coin geared towards commodities. You have one that's geared towards cryptocurrencies. And of course, the fourth one, which is algorithmic based, which was a problem before, that's geared towards building towards models. And then, of course, you have crypto payment companies. Now, let's take a quick view of the broader economy here. digital currency has been around for quite some time. So we have the traditional economy that we're familiar with. We are familiar with centralized fiat currencies. We understand what that looks like. That looks like the dollar, the yuan, the yen, the rupee, the rand. But then you also have this digital economy, which is sliced in two. You have a centralized virtual currency. Within that, we're used to doing that. When we travel on a vacation, we're used to receiving hotel points, airline miles, gaming points. If you go to Chuck E. Cheese's, you're able to get Chuck E. Cheese's tokens, and you can use that. And then you have the decentralized virtual currency, which is geared towards cryptocurrencies, Bitcoin, Ripple, Litecoin, Binance, BNB, and so forth, FTX, which is FTT. Those cryptocurrencies are right now are undergoing drastic changes. Just to keep up with time, there's a lot of things in terms of what the blockchain technology application is doing. This is one of my favorite screens that I like to show. And I think it's what it does, it breaks down into how the technology is being used. And if I had to ask, or if someone had to ask me a question, what's the difference between a crypto and the technology, I would say separate the two. One is crypto, and the other one is the blockchain application itself. And what more firms are doing, at least tier one banks, tier two banks, community banks that I speak to frequently, and a lot of financial firms and the financial institutions, they want to test to see if this technology applies in their operations. There have been some success stories, there have been some failures. Most recently, you had the shipping company with Microsoft, and they decided to turn that particular blockchain application off because it was not as successful as they thought it was, Maersk. So, but there are some applications out there where this could work. Global payments and remittance are fundamental. Peer-to-peer lending is another area to look at. Record keeping, which is the strength for blockchain and cryptocurrencies or blockchain technology itself. There's been talks about title records being used, using the blockchain application so you can restore your information on title records. The healthcare industry is a bit dicey there because there are some challenges with healthcare laws here in the U.S., but this could possibly work maybe in Europe with GDPR. Intellectual property, you'll see this term being used over and over again when it comes down to record keeping, owning that intellectual property. So you'll see this term being used in non-fungible tokens. If we move over, we see the security side, equity, private markets, debt, crowdfunding, derivatives. All those things are happening now. And unfortunately, this particular area is undergoing a lot of changes, especially with what happened with the FTX. So keep in mind that this space, smart contracts, always evolutionary changing, especially with decentralized finance and the idea with smart contracts. So we need to be very cautious with that because with a smart contract, you also have to look at the code behind that and test that code in itself. And I believe we are on our second.
Yes, Danielle.
Wonderful. So here's poll question number 2. I'm most interested in A, blockchain, B, stablecoins, C, crypto, D, NFTs, E, all of the above.
And Ken, while we wait for people to respond there, I did read yesterday, it was the European Central Bank officials on a blog. They said Bitcoin is on its last gasp before irrelevance. And I'm curious, I mean, I suspect you don't agree with that, but do you think that was a Bitcoin specific comment or all crypto, and kind of the difference? Was that specific to Bitcoin?
Yeah, I don't think that was specific to Bitcoin. I think what happens is the industry tends to put Bitcoin and blockchain together. The blockchain application, as you can see, more and more firms are starting to apply it and come out and say we have new products, new services. I don't think Bitcoin is going to die out, actually. I think if there's one cryptocurrency that will probably stay around, it will probably be Bitcoin. It won't probably be at the 16K level, but there's some use cases for it. I know there's some argument. I had this conversation with Bob Pisani from CNBC. 2 days ago, and he doesn't think it's he called it a collectible. And I said, well, people still use it. They actually they offer value for it. Now we have to make sure, how do we classify it? Is it a currency, or is it a security, or is it a commodity? That's really up to the regulators to find out. But I don't think Bitcoin is going to be around. I think what they are looking at in terms of prices, the pricing of Bitcoin may drop a little bit further.
All right. And Danielle, can you get to our poll results? And Ken, we'll have to move a little more efficiently, given we had a little bit of technical difficulties, which we apologize for, and might not be able to get to the last section of the topics. But we anticipate having future follow-on presentations here as well, where we can pick up the topics and as a plug for the feedback of what you're interested in when we get to the end would be greatly appreciated, and we can tailor future presentations around that. So looks like everybody wants to hear about everything, the least about NFTs, which is one of the things I'm kind of interested in, but I got a lot of friends into arts and things like that and trying to make money that way, but it's not going too well right now. Anyway, I'll kick it back to you.
Yes. Okay, everybody wants to hear everything. So I am not surprised with FTX and what's happening. This is just an overview of the blockchain landscape. And I like to share this because this is one of the things that I did during a period of time in June of this year when I attended a conference. And we were just trying to figure out what was going on in this space. And in the space, of course, we're very fortunate to have one of the commissioners of the Security Exchange Commission stop by. But just to go over really quickly, we went over stable coins, what they were, how they operated, what type of new technologies that were out there in the space, what is decentralized finance and what's centralized finance, what is CBDC, what does the CFTC play in this, right? So a lot of the things that this shows, this is a nice roadmap that you can look at just to see that we are all in the same space. The same way with non-fungible tokens, right? Non-fungible tokens, same conversation that we have. I mean, what is it all about? What is a non-fungible token? How are you going to regulate against that? So these are kind of the roadmaps that even the actual blockchain communities have within themselves, as well as with regulators. So oftentimes product, platform, data, we touch that. But most importantly, trying to figure out how do you actually regulate and how do you classify this particular technology and the products of those technology. As we mentioned before, the industry is constantly changing. There's been some growth within the blockchain space. I want to thank CB Insights for this opportunity. I speak to them very, very frequently. Aran is a very good friend of mine, the CEO there. So you can see that this industry is really growing. You have infrastructure and development, exchanges, which are going through a lot of changes at this very moment, custody and wallet services, still around, still operating, NFTs and gaming, which is probably going to pick up a lot more. Payment companies are out there. Consumer yields, I don't know if that's going to be around as much. These companies, and I'm not going to show those companies up, but those two companies are out there. One of them was actually filed for bankruptcy. So you're not going to see that too many people play in that particular space as much. Capital markets, yes, still around. Red tech and security will always be around in this space as long as you actually have fraud and you have some kind of fraud impediment. So, or regulatory compliance, which is needed in this space. Institutional crypto services are still around. And of course, DeFi may grow up, may pick up tremendously. What's happening with that's unique, a lot of the financial institutions had been investing in these blockchain companies. So we like to say that FTX has a broad-based investment portfolio. The financial institutions have been doing the very same thing too. And that's important to understand because these financial institutions like Morgan Stanley, Goldman Sachs, Citi, Wells Fargo, they are basically looking at how they can apply these technologies to their operations. And what I hear frequently is that as a traditional financial play, how do you take a DeFi platform and integrate that into TradeFi? And that's one of the biggest challenges that the blockchain community will probably have. How do you integrate that to, let's say, a HSBC, which is a back-to-back trade organization? How are you able to take a technology to monitor and surveillance against trades that you normally do on a blockchain platform, but can you use that technology and can you use that risk to use that towards a TradeFi platform? Again, as you can see, the growth in the space continue to grow within institutional firms. Institutional firms have always been using this as a way to kind of test to see how this can operate. And when I say this, I'm talking in reference to blockchain technology. They may use this for payments. They may use this for custody. There's some very powerful names on this list. Some of these firms actually have areas that follow blockchain technology. And as we move forward, Danielle, I think we are on the third poll
Thank you,
question.
Ken. All right, poll question number 3. Who should regulate digital assets? A, SEC, B, banking regulators, C, Commodity Futures Trading Commission, D, a newly formed regulator. Just a reminder, you do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards.
Yeah, we've got just a few seconds while we wait for folks. Ken, any thoughts on the impact of the Lightning Network? That was an inquiry made here.
Yeah, that's a very good question. You know, and well, I got to be very cautious in this because Lightning is being discussed for one of the central bank digital currencies. Actually, I think Lightning was used down in Latin America for one of their central bank digital currencies, and it's a good use case. It is being discussed now within regulators. Because it has been a good use case, as well as others. I can't say for sure that that's going to be the choice if there was let's say, FedNow or a true U.S. central bank digital currency, but it's good to have a solid use case within the country.
That's interesting to know, and we won't have time to cover it today, but this falls into, I imagine, phase 2 of the Hamilton project. Is that safe to say what you're part of? Am I in the right spot?
You're on the right spot. I'm trying to be very cautious. But you're on the right spot.
We'll continue the presentation.
But what was interesting here is that many people thought, majority, I think 31% thought a newly formed regulator. I actually said earlier today on TV that the Financial Stability Oversight Council would be probably a great way to establish regulations in this space. And this goes back into that battle royale, right? The regulatory environment is evolving rapidly now, today. In fact, the CFTC, I don't want to underpin them. Their chairman was speaking in the U.S. Congress in terms of what was happening with FTX. Gary Gensler has been very particularly vocal, but he's also a member of the Financial Stability Oversight Committee. That includes the OCC, the FDIC, the Fed. The FDIC is unique because Sheila Bair came out and she was the one that said, hey, we need to also start to look at consumer compliance regulation. And then, of course, you have the CFTC, and then you also have the CFPB, which is the Consumer Financial Protection Bureau. So the crypto industry is desperate for some regulatory clarity. And the regulatory clarity could go around from front running to go around the fraud, to go around the treatment of it, the classification of it, whether it's a commodity, security, or currency, particular areas that we'll explore a little bit more. What essentially happened a lot earlier this year was President Biden executive order to explore cryptocurrencies. Essentially, there was no crypto bans that actually happened. There was a mandate coordination among policymakers, which is actually happening now, possibly beginning with central bank digital currency. That's the digital dollar. I would say that's probably more certain that it will actually happen because there are countries around the world that are exploring this idea. We'll see a little bit later in terms of where that's at. And then, of course, the OCC cites concerns about a run on stablecoins, right? What are we going to do with stablecoins? Do we actually look at stablecoins in a more concrete way? And what that means is how do we put stable coins? Do we put stable coins on the banking side, or do we put stable coins on the security side? And if we do put stable coins on the security side, does that mean that acts as a money market account and you have to register with a registered investment advisor to be able to purchase stable coins? My bet is that stable coins will probably sit on the actual security side, because that's going to leave some concrete room for the SEC and the CFTC to come in. The Commodities Futures Trading Commission has basically taken a lot of the lead, and that's through the Gillibrand and Loomis proposed bill, which hasn't been passed yet, but actually looked at the CFTC as a way to oversee this cryptocurrency and blockchain community. Now, there's been some backlash in that the CFTC might not be the right agency for it, because of the fact that when you look in terms of safety and soundness, the CFTC definitely doesn't have that experience. Or when you look at consumer compliance, that's not an area for the CFTC. So there's some backlash even within the Financial Stability Oversight Committee as to whether the CFTC should have the rulemaking authority for this. So I think it's going to be a combination of both. The FDIC warns crypto companies about representation of insured deposits, right? So the fact that cryptos in this FTX explosion is a prime example of the fact that these are not insured products. You did have some companies out there who was making a statement, or at least making the disclaimer statement, that these could be insured products, and we know that they're not. So when you do purchase cryptocurrencies, know that you may lose everything. Okay, now let's look at in terms of the prudential regulators and global framework, and there's a lot into play here. I come from the Fed. The Fed likes to look at this from a Bank Holding Corp Act, payment system, really key for the Federal Reserve System. Fed likes to look at systemic risk, and they would say, hey, that we think that the cryptocurrency community is a non-systemically important financial institution, so we want to go in and we want to look at this from a safety and soundness perspective. The OCC, when you think of the Office and Control of Currency, you think of the Charter Banking and Federal Savings. There are firms out there that are OCC licensed, and that they are digital banks. The very first one is Vast Bank out in Oklahoma City. So you can actually get a license from the OCC to actually hold digital assets. In terms of borrowing and lending and trading, that's another different story. But at least you are able to have a custodian opportunity or options or operations with the authority of the OCC. Now, in doing so, you actually have to do regulatory reporting. So the key to remember in doing all this, anytime when you register with a regulatory agency, there's regulatory reporting requirement. The Consumer Financial Protection Bureau, very important. You'll start to hear more from the CFPB. The CFPB, what most people don't realize, was the extension of the Federal Reserve Banks. The Federal Reserve Banks used to do consumer compliance examination. They do it to a certain degree, but a lot of that authority went over to the Consumer Financial Protection Bureau, which was first run by Senator Warren, the Senator of Massachusetts. So you'll hear more on consumer protection and disclosures as a result of the FTX debacle. The Commodities Futures Trading Commission, as we mentioned, the Commodity Exchange Act, they've taken the lead in a lot of cases, calling cryptocurrencies is a commodity. When you look into the actual Commodity Exchange Act, you got to figure out whether or not if that's actually written there or if it's actually very proscribed or very elongated. But that's a question to be looked at, whether or not you look at Title VII, Title VI, Title IX. But as you can see, that they're actually expanding their operations, they're expanding their regulatory oversight. The FinCEN, Financial Crime Network, deals more with anti-money laundering, Bank Secrecy Act. The key here for chief compliance officers who are in this space, understanding that with the Bank Secrecy Act, you have to have a designated compliance officer, a designated BSA officer, and that your risk and your compliance program, if you are dealing with digital assets, digital currencies, should include policies and procedures for it and your written policies. OFAC is significant, the Office of Foreign Assets and Controls. They deal more with sanctions and trade embargoes. The Internal Revenue Service, which is very important for taxes, and of course the Securities Exchange Commission, which is going to deal more with fair markets and investor protection, as well as the actual exchanges themselves, whether they're licensed or not licensed, or registered or unregistered. Here are some areas that when I originally put this together, not knowing what was going to happen with FTX, things have changed drastically. But when you look in terms of the types of areas that is happening in the digital assets and cryptocurrency space, these are areas to consider. BSA, AML, ongoing monitoring, onboarding, very significant. You need to have continuous monitoring and reporting of a transaction or operation. That could be on-chain, off-chain, very significant. We saw that within FTX, right? FTX is a C5 platform, but again, you had some exposure. So that ongoing monitor is very critical. There are firms out there that are significant in doing that. Blockchain Intelligence Group, I think, is one of the better firms out there that does this, more better than Chain Analysis. No disrespect to Chain, but I think there's firms out there that have really good products and services that can do this. Digital platform integration, very key and important here. What's happening here and what I hear frequently from a lot of the tier one banks and community banks is, how do you take a DeFi platform and integrate that into a TradeFi platform? So whenever you do that, you always have what they call cybersecurity risk or risk to the operation. So that is going to be a key area that the regulator is going to look at from an operational perspective. Third-party vendors, very important to look at. Anybody who's not a part of a banking operation system could be classified as a third-party vendor. If you are classified as a third-party vendor, then you have to actually have your own due diligence and your own compliance and your own risk. So that's very key to understand in itself. Consumer investor protection, we mentioned that, but there's some key points here. Market manipulation and volatility is one of the key areas that we saw with FTX. Capital reserves and insurance. I was big in saying that, hey, we need to really look at capital reserves. I know that the industry is going towards more statement of reserves or proof of reserves. I think proof of reserves is really just an audit, and the industry needs to really go towards capital structure and infrastructure, because you can have that proof of reserve, but really do you have an actual capital base in place that covers your operations on a day-to-day basis? So we know that we have some issues with leverage, which is really a forefront of liquidity. Do you have the capital to cover that? And I believe we're on the fourth poll.
Great, thank you, Ken. This is our final polling question for the day. What involvement should financial institutions have in digital assets? Please make sure to click the radio button next to your answer and click submit.
Definitely interested to see where people land on this one. And Ken, I think the first time I heard contagion, it was around the time maybe you said it on FinTech TV and stuff, but I think if it was earlier in the year, that might have been word of the year. Might be just a little too late to be declared word of the year. But we got a question in terms of, do you think the contagion, is it going to lead to more bankruptcies or less investment, or maybe there's probably a short-term impact, long-term impact there, but any quick thoughts before we resume?
Yeah, from the investment side, I'm actually hearing that a lot of the investors, I went out to the Oprah Family Office investment function in Napa Valley about a month ago, and a lot of investors were saying, hey, we're going to pull back, we're going to put our money in cash, but we're still going to keep an eye on this in this industry, because there are companies, unfortunately, there's some good companies out there that have good solutions, blockchain solutions, that are really are losing the opportunities or being bucketed in one area. So I think the investment side, they'll probably put their money in cash. You will definitely start to see firms shut down, unfortunately. This has an immense impact on the industry. FTX invested in several companies, and some of those companies are not able to receive that investment as a result of it. So you're going to see a lot more insolvency, a lot more bankruptcy, and it should happen. It should happen because we want to get rid of those types of companies that are not able to survive.
All right, Danielle, the results.
Wow.
Yeah, it's not everybody's scared away from it, which, from my understanding and what we're hearing is there are banks making inquiries of the SEC around accounting treatment and some applications and the whole safekeeping, safeguarding areas, because they're seeing potential opportunity where there's a mess to deal with right now. So that's very interesting. And Ken, we've got 9 minutes left to leave Danielle her closing minute with 13 slides. So I think you're going to have to pick and choose what we cover for the next 8.5 minutes.
Yeah, I'm going to pick and choose this. I am going to go away. I'm going to go more into central bank digital currencies. And I'm going to get away. Well, actually, I want to talk about this, the opportunities as banks, as regulators figure this out. Leverage your banking license for those bankers who are on this call. There are still some services that are in place. Custodial services is enormous in this space. I mean, the great thing about being a bank or financial institution that has that service is that you're safeguarding against not just tangible assets, but in some cases, digital assets. Checking and savings accounts are huge. The rest will be looking to partner with banks like yours, because of the fact that you do have governance, risk, and controls in place, and you do have the first, second, and third line of defense. So the blockchain community is starting to understand what that look like. A lot of the blockchain companies may not know it now, but eventually they will. There's other opportunities such as, keep in mind, crypto regulations, the new ones that are coming out, they're your friends. Don't take it from the standpoint that you don't want to do it. You may have no choice now with FTX. So the FTX contagion changed all that. So when these new regulations coming out, when they do come out, expect it, embrace it, find the right people in place to actually implement that. One of the key areas with regulations is not just taking it and writing bullets, but actually how does that apply to your day-to-day operations and your business as usual? That's really the important thing. Look for regulations in these areas. Stable coins will definitely be one area to look at. Enforcement actions by the SEC, that's still happening in this space. The CFTC is still trying to take a lead. And in fact, they're trying to extend the regulatory oversight to include safety and soundness and consumer regulation. ESG was definitely be in the forefront. You're going to start to see more play on the governance, given what happened with FTX, because we know there was a breakdown in governance. The U.S. Fed and Treasury will remind everybody that this is still part of the payment system. So the Fed and the Treasury will start to be more vocal in this space. And typically, when you get the Fed and the Treasury involved in this, you're going to start to see more robust regulatory oversight. And then we go to more government exploring CBDCs. I'm going to jump into, because of the time, as Aran mentioned, I'm going to jump into, as Gabe mentioned, I'm going to jump into a brief overview of central bank digital currencies. And the reason why I'm touching on this, because the central bank digital currencies are becoming to be a lot more common in this space. And essentially, more and more countries are actually doing more research to see how does that apply to their society, to their economies. Now, uniquely enough, what happened with FTX, and I'll share this, what happened with FTX, there are some challenges now with the Bahamian Regulatory Authority in FTX. And the challenge that they had was, did the Bahamian Regulatory Authority told FTX to put a certain amount of money in a wallet, a central bank wallet? And now the question is, why would they actually use that particular wallet to regain some cryptocurrencies? And maybe it's because they want to use this for an additional assurance for individuals who live in the Bahamas. But this leads into a question, what is actually a central bank digital currency? According to BIS, a central bank digital currency is a digital payment instrument denominated in the national unit of account that is a direct liability of the central bank. The key here is it's a direct liability of the central bank. So this is being issued on the balance sheet of the central bank. And we'll talk about that a little bit more, but essentially what's happening around the world is that you're starting to get more central bank or more central governments exploring the idea of what a central bank digital currency would look like. Now, we currently have, I believe, 3 already. China is considered to be one of the more successful ones. And what China did was China basically started off by working with their regulatory banks, their 4 major national banks, and they had them to actually go back and forth and see what it was like to take this central bank digital currency and run across a payment and settlement system. And then eventually that went into a particular component or section of their society, and they were able to take that and get those results and use that now and implement that on a broader scale. So China basically used what they call an indirect central bank digital currency approach, where their banks were going to be used as a way to issue wallets and issue the token. So what does that look like? There's 2 different types. There's the direct CBDC and indirect CBDC. The direct CBDC is basically your central bank will be responsible for issuing wallets. Your central bank will build the rails out. So it's going to build out the blockchain application itself. And at the same time, it's going to receive, it's going to monitor and track how you use that digital currency. Now, there's some challenges with that. It's going to, onboard you with the Know Your Customer, AML, in terms of you're going to basically have an account with the central bank digital currency. But most importantly, that central bank is going to have that information about what you do with your buying and spending pattern. The other area is what we call a hybrid CBDC. A hybrid CBDC is essentially where the central bank works with their primary dealers. Those primary dealers are basically the banks, and it could be also third-party vendors, and they would actually build up the operation. So the Lightning Network would be an area where they would use for something like this, where they would actually build the rails to execute how that central bank digital currency is being used, the payment systems and so forth, and buying of goods and services. But ultimately, those banks and third-party vendors would have to report back to the actual central bank in itself. And I'm going to leave it here in the midst of time, but we can always talk about NFTs, if not now. But I'm going to leave the floor open. I think we have, Danielle, 4 minutes left. Do we still have more time to talk about this, or should we leave the floor open for questions and discussions, Gabe and Aran?
Let's ask a few questions here, because I think the NFTs were kind of the least popular of things. And so there was, let's see, question here. A lot of interest in the regulator, and could it be a non-governmental entity, or and how successful do you think Congress will be in enacting something which would likely lead more towards governmental? But what do you think regulation realistically will look like, and where it's going to come from in the next year?
I'm going to break that up to 2 sides. I think they were leading on a self-regulatory organization, SRO. There's been discussions about doing that within the blockchain industry. And if you think about FINRA is a model of that happening. And FINRA works directly with the SEC. I think that could be a good area, actually, for this space, that you do still have the level of independence, because the key here is the level of independence and also the level of subject matter expertise. So I can see where, because this is a new technology and a lot of people are still trying to understand cryptocurrencies and blockchain applications, I can see where the industry works very, very well within an SRO, working with a regulatory body. And that body could either be the SEC or the actual CFTC. I don't see that happening within the Fed or the Treasury, but the CFTC or the SEC could actually have an SRO that would actually help them to navigate this regulatory challenge.
All right. Well, with the timing that we have, I think we'll kick it over to Danielle to wrap us up.
Thank you, Gabe, and thank you, Ken, for a great presentation today. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. We will utilize your inquiries for future webcast content. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have any additional questions. If you met all CPE requirements, your certificate is available to download now in the CPE progress window, and a copy will be emailed within 2 weeks should you have any difficulty downloading it now. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. Finally, here's a link to an online survey for today's presentation. Thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.